Hello, dear investors. Welcome to video presentation of our currently running bond offering. So today, joining us is Atsinaujinančios, manager of closed-end investment company Atsinaujinančios energetikos investicijos, shortly AEI. And I am Simonas Žigulis, representing investment banking team at Orion Securities. So the purpose of today's session is to present the bond offering and present the investment company in more detail. So the issuer is not a newcomer in capital markets. The company commenced its operations in late 2020. And since then has raised both equity and debt capital, building a substantial portfolio in renewable energy projects across Lithuania, Latvia, and Poland, spanning both solar and wind assets. Today, the portfolio includes highly significant share of operational cash generating capacity, totaling over 300 megawatts. And the company has already entered this divestment phase and is actively running asset sale processes. So turning to specific terms of this offering, the size of this tranche is 2 million euros, which forms part of a larger 50 million bond program, which issuer launched in November last year. So the bonds carry a coupon of 8.5% per annum. This is a short-term instrument. So under the program terms, the maturity date falls in December of this year. So approximately 7.5 months from now. The proceeds will be used to refinance issuers' short-term credits. Subscription period has started this Tuesday, and will run until next Tuesday, April 21st, inclusive. Speaking about other key terms, we'll go through them at the end of this presentation again. But yeah, we can mention that the price of one bond is around 1,039 euros. So which reflects accrued interest from the first issuance date of this program, and also the minimum investment amount is the same, around approximately 1,039 euros. These bonds are unsecured. However, it is worth highlighting that the terms include several important financial covenants that limit the risk profile of the issuer. So the first one is that at the investment company level, equity must be no less than 50% of total assets. So in other words, equity ratio must be at least has to be maintained at least minimum 50%. Then it's important to mention that overall leverage of the fund is also managed. So financial leverage ratio, which includes both funds obligations, funds debts, so namely the bonds, and also project level bank debt of the subsidiaries. So this consolidated ratio may not exceed 75%. And finally, the issuer is subject to minimum liquidity requirement, where it has to maintain a cash reserve of at least 1.5 million euros at all times. So we'll see the precise figures a bit later in the slides, but it can be said that the issuer is fully compliant with these covenants in the past and going forward. So now I'll give the word to Atsinaujinančios, the manager of the company, and he will present in more detail the company and its portfolio.
Thank you, Simonas. So looking at a snapshot of the company at the end of 2025, the total capacity of projects which were generating cash flow was equal to 303 megawatts. They are split between 117 megawatts of solar assets in Poland and as well 185 megawatts of wind, which are operating in Lithuania. This capacity is expected to increase by additional 47 megawatts by mid of this year, where we'll finalize the energization process for our 114 megawatt solar PV portfolio. So the total capacity of projects which will be generating cash flow will be equal to 350 megawatts by mid of this year. Looking at the track record of the investment company, at the moment we have exited assets equal to 254 megawatts. Our first big sale process was finalized in December of 2024, where we sold 66 megawatts of operating solar assets in Poland. The buyer was a strategic player from UK. And at the end of last year, so in December of 2025, we sold two separate developing stage portfolios, 45 megawatts of wind in Lithuania and 132 megawatts of wind in Latvia to a strategic buyer from Finland. The remaining portfolio is around 1,600 megawatts in total, but this is largely comprised of development stage assets, which are expected to be sold this year, as we are already in the divestment process for these assets. As Simonas mentioned, the financial ratios are in a healthy level. At the end of last year, the total assets on the issuer's balance sheet was 175 million euros, with equity comprising of 89 million euros. In the last 12 months, the total EBITDA generated, which is allocated to the issuer based on the ownership of specific assets, was just slightly above 9 million euros. But we expect that this capacity will increase significantly this year with the additional solar assets being energized in Poland, and also with the assets that were energized in Q4, Q1 this year, as solar generate most of its cash flow during the summer months. One thing to mention as well in terms of the EBITDA, as part of the revenues generated are secured either via PPA contracts or CFD subsidy schemes in Poland. So we do not sell all of our electricity just based on the day-ahead market, which is, let's say, full merchant risk. We hedge it via available subsidies or PPA contracts. Looking at the capital structure, so looking at the snapshot for December 2025, as mentioned, the fair value of equity of the issuer was equal to 89 million euros. The green bonds outstanding were equal to 73 million euros, and then all the consolidated debt on the issuer's SPV companies was equal to 108 million euros. So looking at the capital structure as a whole, it does not breach any of the covenant levels, and it still is in a fairly, in a healthy structure.
Before Mantas continues the overview of project portfolio, and invites all participants to ask questions in the chat and Q&A area, and we'll try to answer them after the presentation.
So looking at the portfolio split at the end of last year, as mentioned, 303 megawatts are in operating capacity. 117 megawatts are operating in Poland as solar assets, and then 186 megawatts are operating in Lithuania in three separate, wind farm portfolios. In terms of under construction assets, we have in total 176 megawatts. So looking at the solar assets, the construction works are finalized. We are now just waiting for the grid operator to connect our projects. and finalize the construction works from their end for the grid connection point. So by mid of this year, we expect additional 47 megawatts to be energized in Poland, and then additional 17 megawatts in second half of the year. And then for wind power in Latvia, we are in the construction stage for the 112 megawatts of wind. The portfolio is already funded on the equity side. At the end of last year, we secured a project financing facility from a consortium of three lenders, EBRD, NIB, and Luminor banks. So basically, all of the further construction works will be funded from project financing facilities. And one thing to mention as a whole, as for solar assets as well, the construction works are now being funded fully from the project financing facilities. So this means that the issuer, EAEI, does not have to inject any other capital for the projects to be constructed until the operation stage. In terms of development stage assets, 1,100 megawatts in total. We do not expect, and we are not planning to inject any significant capital into these assets as well, as they are approaching ready to build stage in the near term, and they will be divested once they are at this stage. The divestment process for these assets has already started, and we expect to divest them in the near term. Looking at the snapshot and the diversification of the portfolio in terms of the technology region and then development stage, fairly good diversification across asset type, across wind and solar, across the geography, Poland and Lithuania, and then in terms of development stage, where more than half of the value of the portfolio is operating at the moment, and this proportion will increase with the energization of the assets mentioned previously. Here you can see a table of specific projects in the portfolio in terms of the ownership, technology, capacity, development stage, revenue hedging strategies implemented at the moment, as well as the fair market value of our equity investment into the asset and the EBITDA results for years 2024 to 2025. So top four projects comprise the largest part and proportion in terms of the fair value of the portfolio. And with the divestment of any of these assets, a significant portion of the total bonds outstanding will be redeemed. And then below you can see three development stage assets. So basically, we are not going to inject any more capital into the development and construction for these assets. We are planning to sign the SPA, basically agreement to sell these assets in the near term. And with that, we'll free up some of the capital injected. And as you can see, the development stage assets in total comprise around 20 million euros. So with the divestment of these assets, the proceeds will be used to redeem the bonds outstanding. Quick snapshot, visual snapshot of the portfolio from the inception. So basically from the date we started operations. As you can see, we exited at the moment four assets. If you look at the graph on the right, one asset is under divestment, with divestment process to be finalized this month, basically. And all of the remaining assets are in the divestment process in some form. Either we are divesting them bilaterally, communicating directly with the buyer, or we have assigned specific sell-side mandates to specific projects to try and approach strategic financial investors for the investment of this asset in the next, let's say, 6, 12, 18 months, basically. Going over the assets one by one. So our flagship asset, 185 megawatts of wind, which we own 25% stake of, together with Tallinn Energia. We entered into this asset on equal partnership basis, so no minority discounts are applied. Project has long-term PPA in place, which allows us to sell half of the generation capacity for a fixed price. The remaining capacity is then sold on the day-ahead market. Project has implemented a long-term project financing facility from a foreign asset manager. And as well, project is participating in the balancing market from the year 2025, which increases the revenue from, let's say, the revenue source, which was not planned at the moment. So a really, really good and successful portfolio. Looking at our solar assets one by one, so we have two separate portfolios in Poland, together 182 megawatts. So the first portfolio, 68 megawatts, 36 separate projects spread across Poland. At the moment, 51 megawatts are operating. The remaining assets will be operational by the end of this year. The construction works are fully finalized. We're just waiting for the grid operator to connect us to the grid. Out of the 68 megawatts, 63 have secured the CFD scheme. So basically, a revenue mechanism where you are allowed to sell your electricity during a 15-year term for a fixed price, and that price and tariff is indexed every year. Long-term project financing in place from Bank PKO SA, local commercial bank in Poland. So overall, a quite successful asset also. We also plan to sign PPA agreements, so basically fixed electricity price sale and purchase agreements for this portfolio as well. Once it is closer to, let's say, the full operational stage, meaning somewhere in the second half of this year. We have signed also a sell-side mandate to approach local and foreign strategic and financial players for a divestment this year. So the advisors are going all around the market, and we expect to receive feedback on potential interest in the near term. Second half of the solar portfolio in Poland, 114 megawatts, 16 separate projects spread across Poland. At the moment, 67 megawatts are operating. All of the remaining assets will be operating by mid of this year. The construction works are finalized from our end. We're just waiting for the grid operator to energize the assets. From the 114 megawatts, 92 have secured the CFD auction support scheme, so the same as in the previous portfolio, which allows us to sell part of the generation for a fixed price. Long-term project financing in place as well from a local commercial bank, mBank. At the end of last year, we signed a new project financing facility with them, refinancing previous construction bridge facility granted to us by EBRD and Eiffel Investment Group, a French-based private debt fund. And to mention as well, the 114 megawatts are also under the sell-side mandate, so being divested in the divestment process as well. And here on the screen, you can see the remaining development and construction stage assets that we have. So one construction stage asset, Zala Triba, 112 megawatts of wind in Latvia, started construction in mid of last year. All of the turbine supply agreements, construction work agreements are signed. The first turbines are going to come to the site this month, basically. Full equity injected from our end. The project is being financed by the project financing facility. No budget overruns, and the project is on schedule, so we expect to energize it in Q2 next year or even earlier. And then the three remaining assets in the development stage. So as I mentioned, these assets are in really late stage development. Some of them already have building permits in place. So we will divest them in the near term as we are not planning to develop them further. And we already have, let's say, interested buyer for these assets. If we look at our track record in terms of divestments, so we started the significant divestment process at the end of 2024. We divested 66 megawatts of operating solar assets in Poland. Our investment period took 6 years. We earned 17% equity IRR. for the equity investor during that period. The buyer was a UK-based investment fund, a strategic player in Poland, buying such assets, and also one of the potential buyers to acquire our remaining solar PV portfolio. And then at the end of last year, so December 2025, we sold another 2 assets from our portfolio, 45 megawatts of wind and 132 megawatts of wind in Latvia. Both were in development stage. We earned the proceeds of 5.6 million euros, and we yielded 18 and 15% IRRs for the acquired projects. Looking at the overall renewable energy market right now, so the projects are being developed further. The capacities are being increased in the Baltic countries and in Poland. So the green transition is ongoing. From our point of view, from let's say a strategic investor point of view, we saw a pickup of interest from foreign players who are looking to acquire the assets in the region. So this co-aligns with our divestment period, as based on our strategy, we are expected to sell off all of our portfolio in the next basically 2 years. So this is good news for us. Also, with the recent geopolitical events, Iran war, we also, saw a pickup of interest from the players which previously were not looking at our region, but with the recent, spike in energy costs and expected, prolonged geopolitical risk. They believe, such infrastructure, renewable energy assets as being, a safe haven at the moment. So, this year and next year, we co-align with such increase. We expect to make significant divestments from our portfolio. And looking at the next slide, so basically a snapshot of the primary inputs that are being discussed. One talked about renewable energy investments, energy price, cost of capex, and expected demand growth projections. So the energy price, as always, I think started from the year 2021, 2022. The projections are higher than what was previously projected. Until then, even with additional renewable energy capacity, we can see that the energy prices will be higher for longer. And what we saw, at the middle of this year, especially in the Baltic countries, the prices were the highest in whole Europe. So given, this energy price forecast that we have on hand, no one can predict, the energy price shocks that happen. So we had the one in the Baltics, but due to the primarily due to the weather, as well as, the another shock can happen due to the prolonged conflict in Iran. So, with these shocks, these renewable energy assets perform. And with the recent geopolitical, events, renewed interest is coming back to renewable energy assets. Again, you can see countries talking about the need to reevaluate their energy independence, and this can only be reached quickly with the renewable energy assets. All the other energy technologies are longer to install, more expensive. So renewables, is the key for the energy transition and energy independence, from the country's perspective. The demand growth drivers, both in the Baltics and Poland, largely remain the same. EVs, energization in the industry, and other sectors. But we also have new demand drivers such as data centers. So I think you all know and see the news of the new data centers developments happening, in the US. But what we see here in Europe, a lot of capacity being installed in the Nordic countries, with them talking about, the need to potentially import electricity from other countries, as these data center demands are nothing what was previously, anticipated. So it's another, let's say, Another unpredicted event that what's not predicted previously that will have to be managed, but this benefits the renewable energy infrastructure players a lot. And then looking at the levelized cost of electricity, so basically a cost you need to make minimum cost of electricity during the life cycle of the project, which you need to hit, to earn your cost of capital. So basically, these are increasing with the decrease, in the technology costs, increase in the efficiency of the technology. So larger wind turbines, better solar modules, and so on. So these are trending downwards. Electricity prices up, geopolitical risks in place. So a perfect storm to the assets in the next few years, basically. Yeah.
Yeah, let's now turn to the risk section. So, as always, before making any investment decision, we encourage everyone to carefully familiarize with the relevant risks. Full description can be found in the offering prospectus. But yeah, let's quickly go through some of the several ones, the key ones. So one of them could be market risk. So there could be movements in electricity prices that could directly affect both the revenue side and project sale value. But yeah, as Mamas mentioned, the prices are not affecting the portfolio in a negative right now, but still there could be changes that could potentially in the future. Financing risks, so primarily, yeah, a challenge for many developers of energy, renewable energy, so raising capital for construction particularly. But in this case, the fund has largely resolved this risk. So necessary funds have been raised, deployed over the past several years, plus majority of portfolio's value is now concentrated in already operational projects. The next, asset realization risk, which is an important aspect for the bonds repayment. So also yeah, the fund is taking measures to control this risk. Also, the portfolio is diversified by technology, by geographically, and yeah, the fund is actively managing the investment processes to ensure smooth sale of the assets. Then regulatory risk. In most cases, renewable energy projects need certain permits to become operational. Other documentation, but in this case, the fund, as mentioned previously, also majority of the portfolio already has required permits and obtain them, and it's not seen as a major risk with the current stage of the portfolio. Finally, some risks related to generally the bonds, financial securities. So mainly liquidity risk, even though the bonds are traded on the market, the liquidity and of them is not guaranteed. So anyone planning needing to sell these securities before the maturity date should take that in mind. And then yeah, let's overview, recap the transaction. So the key dates, the offering period started on Tuesday and is running until April 21st, inclusive. And then on April 22nd is the settlement and issue date, and on this date the securities will be accounted on bondholders' accounts. Final maturity of the bonds is December of this year. The subscription process is the same as in other bond placements. So the investor must have a securities account, and you can open that in any financial institution in the Baltic states that provides investment services. So yeah, you can turn to your account manager at one of these institutions, or use the self-service platforms to subscribe to the bonds. And yeah, as mentioned, and the timeline is until April 21st inclusive. Yeah, finally, the key terms and conditions already, and we went through them, most of them already. The tranche size is 2 million euros, part of the larger program, bond program from the issuer. The coupon is fixed at 8.5% per annum. The term is until December, so roughly 7.5 months. Issue price is around 1,039 euros, reflecting accrued interest. It's important to mention that the issuer is rated by Scope Ratings, having a double C rating. And the issuer also has a early redemption possibility. So if asset divestments go a bit faster than planned, the issuer has a right to redeem the bonds earlier. Summing up this, the issuer and the current bond issue. So the AEI is characterized by strong financial position, having book value of equity at close to 90 million euros, and then having strong capitalization with equity ratio of over 50%. Operationally, it's performing well, having achieved over 9 million euros of EBITDA, with the projected growth as well, with new assets entering operational phase this year. As mentioned, portfolio is quite diversified by different technology and geographically, and then more than 300 megawatts already at the operational phase, generating cash flow electricity. Talking about this sale of electricity. So majority of electricity production sold to government-backed schemes or investment-grade off-takers. So meaning that this cash flow is predictable and stable. And finally, the investment processes are already underway. So pretty solid track record of project exits already, with more than 250 megawatts, and the further processes already in place and accelerating this year as well as the next year. So we have went through the slides, and now let's go through the questions from the audience. Most cash flow is secured through long-term PPA and CFD contracts. So of course, people can see that in the presentation, but maybe you could just describe, Mantas, what share of revenue are you roughly hedging with these?
Yeah, definitely. So it depends on project by project, but if we look at our three operating, let's say, projects, which are 185 megawatts of wind in Lithuania, and then 68 megawatts of solar in Poland, and then another 114 megawatts of solar in Poland as well. So 185 megawatts of wind in Lithuania sells half of the electricity generated via a PPA contract. It's a long-term PPA contract which will expire in the years 2020, 2033, 2034, and then the remaining is sold under merchant. With the Polish portfolio, what we have at the moment is the majority of the assets have this like CFD tariff in place, a 15-year tariff, which is indexed every year and allows you to sell part of the generation for a fixed price. So how we structure this CFD tariff is that from years 1 to year 10 of project operations, we sell around 10-15% of the generation to the CFD scheme. And then from years 11 to 15 of project operations on the tariff, we sell 85% of the electricity generated for this fixed price. The reason we do it is that throughout these 15 years, the tariff is indexed significantly. It's above, let's say, the market price, and it's really beneficial to then sell majority of your electricity at this high energy price. Now we have a gap in Poland for the first 10 years where only part of the electricity is sold for fixed price. So what we're doing is that once the project is fully energized, so for 140 megawatts, this will be middle of this year, and then for the 68 megawatts somewhere second half of the year. Once we're fully energized, we are signing, let's say, a PPA contract to sell 50+% of the energy production during the next 3 to 5 year window for a fixed price. So basically in Poland, we will have a mix of revenues between merchant, so selling electricity on the day ahead market, PPA, and then CFD scheme. And then in Lithuania, it's going to be merchant and PPA, as there's no subsidy schemes at the moment, that we can use. So if we take the whole EBITDA generated for the portfolio, I think at the moment, without including the PPAs that are planned to be signed for Poland, around 20 to 25% is hedged during the next 10 years. And then during years 11 to 15, around half of that is hedged. But once the Polish assets are energized, and we will be signing these PPAs. So this first 10-year period will also be, let's say, 50% or above. We're just, waiting for the project to be fully de-risked for any delays, and then we're signing a PPA and starting selling electricity in Poland also under the fixed price contracts there.
How sensitive are exit valuations to current interest rate levels?
So we have the sensitivities in our financial statements. I mean, depends. This will affect WACC primarily because we model everything on the free cash flow to firm basis, and then we apply the WACC with the debt assumptions included. So this will interest rate rise will increase the cost of debt. Another premium. So basically. We need to look at WACC sensitivity for this.
If electricity prices fall in Poland or the Baltics, how much do you have exposure? How vulnerable are you?
Again, sensitivities. We have sensitivity table in the financial statements for the specific metric. But looking at our, let's say, valuation assumptions that we use. So we do a year-end valuation every year where we take the whole portfolio, put all of the assumptions for the cost of capital, all of the expected energy price forecasts, inflation and everything, just package the whole thing, do like DCF analysis for some of the assets, other assets which are early development stage are valued at cost. But basically, one valuing assets which are valued based on the DCF method, when we look at the electricity price forecast, we apply the base case scenario from top 3 market predictors in Europe, and those assumptions, I would say are not optimistic. So they assume the upcoming demand, supply forecasts, the price, the forecast, for commodities. So, just even looking at the previous forecast, our assumption assumed like 30 euro gas price, during the long term. And when comparing even the forecasts that we did at the end of last year and what we had during the first 3 months in the Baltics, the actual prices were twice higher than what we had on those forecasts. So we don't apply like a really aggressive market price forecast estimates there. So yeah, they're just something to keep in mind. And also all of our valuations. So basically, with DCF analysis and so on. But you also like back tested against the comparable market deals. So all the values there are compared against the benchmark deals that we saw in the region. But just give you an example, looking at our Polish assets, what we valued them at the end of last year, and what we saw in terms of deals that happened in the last 3 months, we are, let's say, below valuation. So meaning there's like a uplift there or a cushion you can get from the market, the value you have on the books, and what you can actually exit the asset at. So,
thank you. What do you see as the most material risks to your business over the next 12 to 24 months?
So, from the bondholders' perspective, the primary risk is the exit time frame. I mean, looking at our whole platform, I mean, we have a large operating capacity of assets in Lithuania and in Poland, and we'll also, maybe even have the asset in Latvia if it's not invested, let's say, earlier. So, this capacity covers your ongoing project financing expenses as well as the interest expenses to cover, let's say, the green bonds amount. So it's only I think the primary risk is the exit timeline, but we have, as mentioned, we have all the processes are started. We should make some of the divestments by mid of this year already, and then the other ones will follow through. But as showed on the table, if any of these like significant top 4 assets are divested, which are in operating or construction stage, a large chunk of the green bonds are redeemed because we are not investing any more money into further expansion, meaning development or capex. So all of the money that we receive, it goes straight to the redemption of bonds, basically. So in terms of risk, it's probably the exit time frame.
How do you see the current buyer universe? Is it more strategic or financial investors?
So last 2 years we had like a really low buyer's market, but we saw a shift, I think, towards the end of last year after the summer ended. Looking at our portfolio and what the buyers were dealing with, it's mostly strategic ones. But the financial ones are more interested in our operating assets. So let's say the flagship 185 megawatt wind farm in Lithuania, and these players, the ones we're dealing with, they have not previously bought any assets before here in the region. So this is a new players not looking at the region, just looking at the next potential geography to expand, and they see Baltics and Poland as being, let's say, one of the better regions to deploy capital in Europe at the moment, specifically to renewable energy sector.
Do you see data centers as something already impacting the current price levels, or is it just a potential for the future?
So these are being built out. You can see probably some examples in the US. For those, price shocks that happen, locally from the data center build out. But in terms of new development, Nordic countries, experiencing a significant growth and like a large, you can probably every week you can see some projects being developed in Norway, in Sweden, and Finland. We see also a new project development in Poland, in Lithuania. I think nothing significant at the moment, but if the neighboring countries are neighboring countries are deploying such assets, the wave will eventually come here as well. And with that, these data centers, at least on the projections, are significant electricity users. They need electricity 24/7, meaning you have to be hooked, to the grid all the time, So yeah, with the projections we see, this could be one of the energy shocks, with the new data center build out. If nothing, let's say, significant happens that dampers your development or AI market crashes or whatever. But one thing to mention as well is that those AI data centers are not, let's say, one of the primary drivers of this data center build out. So there's other types of data centers that are as well being built out and will be using electricity there.
Are you exposed to any grid capacity constraints
Yes. So grid capacity constraints are now affecting Polish solar assets, and this has been the theme from last year. In Lithuania, you also have some curtailments, for solar, for wind even, but what will happen in the next probably 2 to 3 years is with the deployment of these battery storage solutions, they will come to the market, and they should significantly reduce the curtailments, and in the next whatever 5+7 years, they should be at a minimum, a few percentages probably from your annual generation. So for you to understand, when a lot of renewable energy capacity came onto the market, in the Baltics and in Poland, the grid was not meant to, let's say, to have such assets operating, because the grid is inflexible at the moment. You need to update the infrastructure for allow you to successfully distribute the electricity across the region, let's say during peak demands, when there's, let's say, a lot of solar and wind generating, and you do not have like a way to transfer this electricity to like a specific user somewhere in the country. So as the grid infrastructure is being updated, in Lithuania, you can see the cash being deployed here, and in Poland, significant amounts of capital are being deployed to grid infrastructure improvements. In the meantime, what will balance out these like curtailments, grid restrictions, are the new best capacities that are coming to the market, and these, the first best capacities that will connect, in Poland and Lithuania, will probably have really short repayment terms, as the need for the balancing is significant right now, so they will come, they will just balance out the market, and this will be like a benefit to asset owners who own, let's say, solar and then wind assets.
Thank you. And there are a few questions about exits and repayment of bonds. Maybe you could just once again summarize what are the main sources and plan for the redemption of bonds.
So besides the investments that we've mentioned, showing the table of assets with their fair market values and the investment process is engaged, we have a few other, capital inflow sources which were not listed there. So in the near term, we're looking at a few. So basically, we plan, to divest a few development stage assets in Lithuania, which can yield, basically from 7.5 to 10 million euros of capital in the near term. Then we should receive around like 5 million euros of inflows to the fund level from the project we sold last year. So basically just receiving the inflows this year, and then around 13 million euros are expected to be received from Poland, basically PLSun, 114 megawatts of solar PV. We refinanced this asset at the end of last year. We had a construction bridge financing before, and now we got the long-term senior financing in place under the higher leverage, which allows us to free up 30 million euros of equity, basically upstream it back to the fund level. So we expect to upstream this cash in June. What needs to be done by then is basically all of the projects have to be energized, and we need to receive, let's say, this like final permit of use documents from the operators. So once that's sorted out, the bank will free up 30 million euros for us to upstream back to the fund, and this cash will be deployed to service the green bonds outstanding, and then also redeeming part of it. So besides these capital sources, all the other ones will come from the asset divestments and the operational proceeds as well.
Thank you. Yeah, that was the last question. So yeah, just to summarize the current issue, bond offering is ongoing until April 21st inclusive. So thank you, Mantas, for presenting. Thanks everyone for tuning in. If you have any further follow-up questions, please do not hesitate to contact Orion Securities team. Thank you and goodbye.